Good morning. I hope you're all well and surviving the cold. It may not feel like it in South Africa, but this month, on the 6th of July, was the hottest day on the planet in recorded history. And the scientists extrapolate that it's actually the hottest day in over 100,000 years. So things are certainly warming up in the Northern Hemisphere. And fortunately, that fed through into the stock markets, and we had a rather hot month in the markets and the rand, which was very exciting to see. So let's review the asset classes performance for the month of July. As you can see, they're quite an incredible performance. The rand stronger by 5% over the month of July. So that's the bottom orange bar. You can see that dollar cash minus 5.3%, i.e. the rand strengthened by 5.3%. So if you're holding dollar cash, that was your return. And the strong rand did make most markets look negative in rand terms, but all markets were actually up for the month. Risk was on. And why? Well, the big driver was a very dovish inflation number out of the US. And markets rallied on the good news about inflation and the prospects of a soft landing. And we also had the International Monetary Fund. Their July World Economic Outlook was slightly more upbeat than the April one, and they revised growth up, global growth up to 3% in 2023 and 3% again in 2024. So things looking a little bit more stable as we come into the middle of the year, markets reflecting that and bouncing nicely. The biggest performer, or the best performer of the month, was China, up 5.5% in rands, up nearly 11% in dollars. And that was on the results of the 24th of July Politburo meeting and some very positive promises coming out of China. Not so much facts or details, but promises. So they're taking a leaf out of South Africa playbook there. And I'll be talking more about that in detail when we get to China today. A lot happening in the China space, a lot of movements in the market as well. Okay, so let's get on to the outlook. Well, the bad news is despite a good start to the year, the outlook is the most uncertain it's been in 20 years. This chart shows the forecast for the S&P 500, that's the US stock market, the S&P 500, the analysts' highest and lowest targets and the spread between that. So you can see the spread this year, and there's only 5 months left of the year, less. There's 50% spread between the highest and the lowest expectation for the S&P to end the year. The last time we saw such a big spread was 2003. Now, 2003 was a good year, and that was the start of a 6-year bull market. I'm not saying we're going to have a 6-year bull market, but it was the last time markets were this uncertain. Why? Why are markets so uncertain? Partly it's driven by the FANG stocks, and the important point here is the FANG mega cap stocks. The FANG stocks are so big and have had such a big influence that the AI rally that's happened year to date has driven the MSCI All Country World Index, that's basically MSCI's everything index, up 14%, versus the equally weighted version of the same index only up 5%. So you're getting nearly triple the return on a global basket of shares, just driven by maybe 6 or 7 US FANG stocks. So that's having a huge impact on market returns, and that is impacting expectations towards the end of the year, whether you think this FANG rally is sustainable or not. But I think it's more than that. We're also seeing geopolitical risks rise exponentially in July, and that's creating a lot of uncertainty as well, because the risks are, if we do see a rise in oil price or a rise in food price inflation, that's going to cause some serious problems down the line. So let's look at that. So unfortunately, in July, we had Russia ending the Ukraine Black Sea grain export deal, nearly a year into that deal. And that significantly increases the risk of global food shortages and sharp increases in food and fertilizer prices. In fact, we've got the UN warning that many may die as a result. And Africa is the hardest hit by food security risks, and only 17 heads of state compared to 43 when Putin last hosted the Africa Leader Summit in 2019, attended. So less than half heads of state attended the Africa Leaders Summit in St. Petersburg this month as a result of the ending of the Black Sea grain deal. So certainly that does raise a lot of geopolitical risks. Ramaphosa was one of the heads of state who did attend, so he wasn't too concerned about the end of that Black Sea deal, or was hoping to change Putin's mind and get it reinstated. But it does raise risks. The charts on the right there shows how over the last year, you can see oil prices and food prices have fallen dramatically, and that disinflation has helped the headline inflation number come down. In fact, US headline inflation has fallen from 9% to 3%, and that's helped the world recover and the world rally because the concerns about inflation are hopefully behind us. But they are definitely not. There are risks that oil price and food prices could rise significantly from these levels if Russia starts to do more saber rattling. And it's no surprise that that Putin ended the Black Sea grain deal on exactly the same day that the Kerch Strait Bridge was further compromised. That's a really, really important Russian strategic military asset. And the fact that it has been compromised effectively strands 2 million Russian soldiers in Crimea. It reduces Russia's ability to get transport, to move fuel into that area, to move food in and weapons, and definitely dents their ability to wage war. So no surprise that that Black Sea grain deal was ended on the same day. So risks to food prices, certainly, if we start to see more Russia saber rattling, but also to the oil price. And what's been interesting over the last 18 months is we've seen Russia's oil traders shifting to the Middle East. So through intermediaries, China and India and Turkey are buying oil at a discount to world prices. And they're doing so by buying oil from sanctioned countries like Russia, but also Iran and Venezuela, who combined make up 20% of global oil exports. And they're buying that sanctioned oil at a discount to global prices through the Middle East. So that's a very, very interesting development in the oil market. And certainly it's helped keep inflation low, it's helped keep oil supplies high, and it's helped to reduce inflation. And that oil is being sold not in dollars, but it's been sold in local currencies of either the buying countries, so in the currencies of China, India, or Turkey, or in Russian-friendly currencies, depending on who Russia sees as their friends. And this has also led to the oil price dislocating from the rand dollar price, because the dollar price, because now those countries no longer need to buy dollars to buy that oil. I mean, then as a result, we're seeing less demand for oil in the short term. And this is one of the structural changes we have spoken about. And we do think that it's going to continue, that as the US continues to weaponize the dollar, so countries are just going to start to trade commodities in their own currencies and avoid the dollar. However, if Russia further reduces its oil supply, i.e. oil is still coming into the world via the Middle East. If Russia starts to reduce that oil supply, well, then we could see oil prices start to rise. And if oil prices rise and food prices rise, inflation will tick up. And the scary thing is that growth is now recovering. And if we get to the point where growth starts to roll over, and inflation starts to tick higher, then just as the central banks need to start cutting rates, they won't be able to. And then we'll face a lot of problems. So this is why we're seeing this massive divergence in the S&P 500 year-end target, because we could stay in a Goldilocks where Russia doesn't change anything, geopolitical risks don't arise, growth stays, let's call it tepid, inflation continues to fall, and everything continues to work. And then we just actually muddle through the recession, which never happens, and earnings continues to rise, and we move into another bull market. But and the market's pricing that in quite as a base case scenario, so certainly not too much upside if that happens. But if we do have some recurrence of a black swan event, and not black swan in that we don't know, but a recurring black swan, the ones we've seen over the last year or two, and if that happens at exactly the same time as central banks need to cut rates, well, then we could have a very deep recession. So a lot of uncertainty. And generally in geopolitics and geopolitical risks are rising, and this uncertainty is rising, and this low growth is leading to a lot of unrest. It was not just the end of the Black Sea grain deal that happened this month, but we also saw, for the first time in 4 decades, the US brought a ballistic submarine into a South Korean port. And for first time in 4 decades. And as a result, North Korea launched 2 missiles. So things are starting to heat up in North Korea. We also saw Israel's parliament pass a bill which reduces the power of courts to oversee political decisions. And that drove hundreds of thousands of people into the streets to protest. A lot of uncertainty in Israel, and that's impacting the Middle East. In France, we're seeing the pension protests continue, and those riots are estimated to have cost France nearly, more than €1 billion. And it's a huge amount of money as protesters are unhappy that the retirement age is being raised. But in reality, when markets are going to give you low returns because interest rates and inflation is lower, you either have to save more or work longer. So there's not much way around that. But anyway, that's protests happening there. We also saw China hit back on the US. China has limited exports to the US in 2 key metals, gallium and germanium. I've never heard of them. I don't know if you know about them. I had to Google them to make sure it wasn't fake news, but it is true. China has limited those 2 metals. So a lot is happening that can impact the outlook of the rest of 2023. We also, in July, we saw the 2023 NATO summit take place. And we saw Turkey finally agreeing to support Sweden's application to join. And that possibly another reason why Putin has started to become more defensive. I mean, a lot of reasons. It's the Kerch Strait Bridge. It's Sweden joining NATO. It's the fact they nearly had a mutiny in June. So a lot of things are causing Russia to lose the war against Ukraine, and that raises the concerns that things might get more desperate. And when things get more desperate, well, anything can happen, unfortunately. So that those risks are certainly increasing. At the same time, as those risks increase, the chance of the Ukraine being added to NATO decreases, because no one wants to see World War III happen anytime soon. Obviously, that's not in Ukraine's best interests, and there's a lot of disappointment there. But I think in terms of world volatility, it's makes a huge impact as to what happens in that region. So a lot of risks are happening, a lot of uncertainty, the most uncertain outlook over the rest of this year in 20 years, and having had a good start to the year and a good 6 months into the year, we certainly are putting on a bit of protection and taking a bit of risk off the table and locking in some gains. Let's focus on each of the key drivers to the global economy, like we normally do. Starting off in the US, the Fed raised the interest rates by 25 basis points, up to the 5.25 to 5.5 range. Markets expect this to be the last. In fact, markets are expecting first rate cuts to start in March next year, so 8 months away until the first rate cut. But the Fed is not giving up anything, keeping their options open, and they say, you have Jeremy Powell saying, we haven't made any decisions about any future meetings. Basically, it's all data dependent, and they reserve the right, as is their right, if inflation starts to rebound, that they will push interest rates, more interest rate increases through. But the market isn't expecting anything. What could be a cause of concern is that although the June CPI cooled dramatically, I mean, it fell to 3%, it's less than a third of the 9% peak it hit just a year ago. The July CPI is forecast to pick up a bit. It's just base effects, but as you can see, on the previous chart when I showed you oil price fall and the wheat price fall, there are certain basic impacts where inflation is going to tick up again in July. So markets are expecting it, but at the same time, if it does pick up a little bit more than expected, well, then we could have a lot of jitters if the markets then think that the Fed could hike rates again, or it's no longer the end to the rate hike cycle. But basically, markets are saying it is the end of the rate hike cycle. Let's look through that. Let's start looking towards rate cuts. And when the early cycle of rate cuts, well, that's normally quite good for markets and quite bullish for EMs in particular. And we've seen some decent rallies happen this month. So what's interesting is looking into that inflation number, and the entirety of that pullback from 9% to 3% has been driven purely by supply side factors. So it's all the temporary factors that happened as a result of the Russia-Ukraine war, as a result of COVID. We've seen oil prices fall. We've seen supply chain disruptions being fixed. And the COVID stimulus has moved out of the base, and all that cash has been saved during COVID. A lot of that has been spent, particularly in the US. So that 9 to 3% is all supply side. It's still too soon for the demand side to take impact, and we are seeing that with strong growth numbers coming through. But as those delayed impacts of high interest rates start to impact the demand side, well, then demand inflation will also fall, and that's why inflation is likely to continue to fall in the US, and that's why it's likely to be the Fed's last hike, assuming no geopolitical risks which push up the supply side inflation risks, i.e. food or oil. And we can see that. I mean, it's not just the lagged impacts of high interest rates, but we are seeing tighter credit lending standards. We're seeing softer housing pricing in the US, and that's all going to lead to growth headwinds, which will slow inflation. And it's not just on the supply side, but if you look at the chart on the right there, we've got the temporary help, which is the light blue line, that's fallen into negative territory, and that tends to lead employment in the US by 6 months. So that is a very strong indicator that employment is also going to start to roll over quite soon. And then with softer supply side inflation and softer employment, that certainly means that the US is going to be softer on the demand and the supply side, and hence inflation will continue to fall. And because of that softer inflation, right now, the consumer is looking quite resilient. The consumer expectations and sentiment has improved, and that's how markets have improved, and things are looking quite good. So right now, markets are looking good. They're pricing in a Goldilocks story that inflation continues to roll over as the delayed impact of interest rates start to reduce the demand side. There are risks. There are risks that growth falls too much because of the delayed impact of interest rates. There also are risks that some sort of geopolitical event happens and inflation is pushed up. But assuming no risk on the geopolitical side, and assuming that growth doesn't slow too much, and assuming we stay in this Goldilocks scenario of not too hot, not too cold, well, then things are looking good. But it is certainly quite a narrow window the markets are pricing in terms of the outlook, and definitely a best case scenario that is being priced in. So risks continue to exist. The other major economy driving the market is China. Now, the interesting thing is that China is starting to impact the market, not so much through growth as they have in the past, but inflation. And it's the low inflation in China that's actually helped inflation surprise to the downside in the rest of the world, which has helped this bullish rally we've had. So the world has rallied as inflation has surprised the downside, but it's been driven by a weak China, which is not good for China. Good for the rest of the world, but it hasn't been good for China. But as a result, China is doing some serious backpedaling. 2 years ago, as you can all remember, they unleashed some serious policy changes which wiped out billions of dollars, hundreds of billions of dollars of market cap in the internet platform companies and online education sector. They are trying to reverse that aggressively. And here you can see President Xi Jinping himself greeting Bill Gates in Beijing, calling him the first American friend in Beijing this year. And at the same time, we've had Chinese Premier Li, who's met with all the large executives of the internet platform firms, Alibaba, the food delivery group Meituan, TikTok owner ByteDance, which we know is owned by Tencent, and calling them the trailblazers of the era. And both Xi Jinping and Li Qiang saying that they're promising that policy will not change without consultation going forward. Basically saying, 2 years ago, we made a mistake. We're very sorry. It won't happen again. We need to get the private sector going again in China. And that's no surprise. Basically, China is experiencing a growth squeeze. They're experiencing disinflation. China's growth slowed to 0.8% quarter on quarter in Q2, although 1H was still above its target of 5.5%. It's slowed. But more importantly, PPI came in at minus 5.4%. That's the lowest it's been since 2015. And CPI is expected to be negative this month. So China looking very disinflationary, even deflationary. And a lot of that's because of the weak property sector, but it's also driven by the lack of fiscal support in China. So the chart on the right tells the whole story. So 0 is the top white line there. And that's a balanced budget, which most economies are ideally supposed to keep. The US is the dotted blue line, and you can see the US has been incredibly, I don't want to say irresponsible, but they've been incredibly supportive of the economy on the fiscal side. So looking back at the great financial crisis in 2010, where you had nearly 10% of GDP in terms of fiscal support to get out of the great financial crisis. Then in COVID, double that. The huge amounts of money that was just printed, huge amounts of fiscal support that was used to drive the economy. And the economy is still flourishing as a result. But that's all being borrowed from the future. So it's important to say that while it's helped the economy now, they've taken on huge amounts of debt to do that. But the US economy is bouncing back very strongly, as we've seen. But it will slow, and at some point, the US needs to rein in that fiscal support or face further debt ceiling constraints or credit downgrades. Comparatively, China has been quite frugal. And you can see that the dark blue line there, China hardly had any COVID support. And that's as a result, the Chinese consumer hasn't bounced back nearly as aggressively after the COVID lockdowns were released. And that's it seems strange that China, who's being conservative and they're not using excess debt, well, they're facing this deflationary environment. But it comes down to the fact that China is actually the largest saver in the world. The country has the highest savings rate, over 43%. In terms of savings balances, the highest savings rate of any consumer, and that money, when it's saved in debt, or you actually need to take on debt on the other side. So there's a lot more to the story than meets the eye. And in fact, China is being way too frugal with the amount of debt. And they need to take on more debt, and they need to stimulate the economy, and they need to do that to get out of their property bubble that has burst. So there's a lot of similarities between Japan and 50 years ago and what China is going through now. China can afford to take on more debt. China needs to take on more debt. China needs to stimulate, but they're not. What they're doing is they're adhering to this strategic focus where they are focusing on the property sector and they are deleveraging the property sector. But beyond that, they're only promoting advanced technologies and very much focusing on the tech sector. So without the broad-based stimulus that the US has used and Japan has used, China is not going to, unfortunately, it's going to be stuck in this debt deflationary era. So that's not good news for China. The good news for China is that the de-rating that the stock market had 2 years ago because of the very harsh policy changes that happened that impacted the internet platform companies, that has reversed. And we're likely to see more continuation of confidence in that sector. So the People's Bank of China, they fined Ant nearly $1 billion, and they fined Tencent nearly $500 million. But they also announced the end of the 2-year investigation. And Alibaba's share price is up 21% on the back of that announcement. So there's certainly a lot more good sentiment in the tech sector, and we think that that as those large platform companies roll out their AI models, there's going to be a lot more confidence slowly coming back into China. Yes, it'll be slow. A lot of people got burnt. A lot of people are saying, well, Xi Jinping, unilaterally made these rules 2 years ago that hurt private investors. How do we know he's making promises today, but how do we know he's not going to change those promises tomorrow? Yep, that's definitely a risk. It's a risk that's always been around in China, but China is trading at the cheapest level it has in the last 2 decades. And I think that, we've seen a 10% bounce. I think there will be more confidence returning to China going forward. But it's going to be very much focused on the tech sector, on the sectors that the Chinese government is supporting. It's not going to be on the broader China economy, certainly not on the property sector. Even the consumer is not going to do as well. So we've changed our China focus. We had our focus to the China new economy sector, which is very much tech plus consumer. Didn't have any property stocks, so we were protected against that. Didn't have any resource stocks, so we were protected against that, or SOEs or bank stocks. So we were on the right side, but we didn't expect this lack of stimulus. So we're now rotating out of that China exposure into more China tech focused exposure. And as a result, we are also reducing our China from a medium overweight to a small overweight. We've also, announcement will be coming out today, we are closing our China unit trust. We are keeping our China ETF open. We do think that China still does have, as the largest economy in the world, is still an important part of an investment story. But until we see broad-based stimulus come out of China, and we don't expect it because of the strategic focus and the very conservative measure that Xi Jinping is using, well, until then, we're going to keep a very narrow focus on China, on the tech sector. We have reduced our exposure to small overweight, and we are closing the China unit trust, and we're keeping our exposure through our China ETF. So that it is quite a big change. We do think that theme, the next billion emerging consumers, is very important. It is going to mostly come from emerging Asia, India, China, Korea. It's all Vietnam, all very important. And we think that theme is strongly on track. Just until we see a more broad-based stimulus from China, we are reducing our overweight in China to more in line with the EM benchmark. So it is quite a big change, and it's mostly driven by the lack of government support and the government sticking to their strategic focus. And unfortunately, I can see where the government's coming from. They're looking at this chart and they don't want to take on too much debt, and they're trying to be conservative and run a proper balanced budget. But there are times, particularly when you have a property recession, that you do need to take on more debt, and particularly when your economy is so driven by savings and it's at such high savings rates, and when your consumers aren't spending, well, the government needs to step in and spend. So we'll be watching that very closely, but for now, reducing our China overweight to a small position. Moving on to South Africa, we saw 115 companies pledge to help the South African government improve, which is a fantastic initiative. Sygnia is proud to be one of the signatories. We do think that the private-public partnership is the way to go. We saw it work incredibly successfully during COVID. We're seeing it now in the renewable energy space. Private sector is helping the overall economy incredibly well, and we think that the private sector and public sector should continue to work together. And we hope that the NHI changes to a model which embraces that. Here you have CEO of Business Leadership South Africa, Busi Mvuso, calling the government a leaking bucket. And she says, and this is part of the reason why 115 companies did pledge to help the South African government. She says, with the state failing in its fiduciary duty to provide basic services, companies will probably continue to play a bigger role in tackling problems. And more importantly, governments will be forced to. Now, we've seen Investec running traffic lights. We've seen Discovery plugging potholes. The mining companies are providing healthcare services to the local areas, the communities where they have their mines. We've seen food producers rolling out water supply to their local communities and their local towns. The private sector is having to step up. Unfortunately, it's a tax on earnings. And that's certainly why we've seen some very, very weak earnings come out of the South African economy. But it's a necessity. It's helping the economy, it's helping the people. It's an important investment in our social stability as well as infrastructure. Working together, there is a much better outlook for South Africa. As long as the private sector is allowed to partner with the government, I think that things will improve. Unfortunately, right now, we still are struggling with the lack of public power. Load shedding again is hitting stage 6. But the good news is the private sector did add 2,400 megawatts in Q1, where unfortunately the round 5 of the renewable stage is only half of that has net production because of a lot of red tape, and that's so the private sector once again coming to the rescue on the private side. Meanwhile, cabinet has agreed to throw 6 billion rand at the post office to try and bail out that struggling SOE. So we'll see what happens there, and a lot of concerns about what's happening at SAA with the privatization there, and Transnet also a lot of concerns on the rail side. Not only that, but South African income tax receipts fell 24% year on year relative to June. And so that's tax revenue is down 24%. Meanwhile, expenses are well ahead of budget with the implementation of a 37 billion rand increase in the public sector wage bill that wasn't budgeted. So we're seeing a divergence between revenue and expenditure in South Africa. Over the last 3 years, we've had the commodity windfalls, which have allowed us to spend more than we need. Because income has surprised on the upside, and we've actually had pretty decent budgets over the last 3 years. We've actually had some debt consolidation, despite all the stuff that's going wrong, because we were saved by resources. But resource prices have fallen over the last 6 months, and that's feeding through into quite scary looking debt to GDP numbers in South Africa, and that's why bond yields have been weak. There's certainly a lot of risk there. Fortunately or unfortunately, a lot of it's priced in to the bond market, so we do remain overweight South African bonds. They're close to the highest real yields in the world, but it is a red flag. At the same time, because of all the concerns about infrastructure, the railway, Eskom, Nedbank's fixed investment survey, which values new projects in 2023, they've annualized the first 6 months, and the numbers come in at 170 billion rand, 170. That's compared to 250 billion last year and 400 billion the previous year. So investment in South Africa has plummeted, and for good reason. If there's no power, no one's going to invest in anything. But no investment means no growth. It means no jobs. And it means no return on equity, and everybody loses. So we desperately need things to get fixed. There is definitely light at the end of the tunnel in terms of load shedding towards the beginning of next year, but right now things are looking pretty bleak. So we remain underweight South African equities, and we've again taken more offshore over the past month. Okay, so it's looking pretty bleak. What is looking good? Well, inflation has dropped, so that is a good thing. Inflation is now 5.4%, so that does bring some relief to consumer, although we are expecting petrol prices to go up next month. But at least that's allowed the SARB to keep interest rates flat at 8.25%. So that's again a little bit more relief for the consumer, but the consumer is very, very stretched. We also saw the rand increase significantly over the month, as I said, 5% strengthening over the month, which is very good for imports, whether you're importing solar panels or inverters or Eskom turbines. A stronger rand does help on the import side, so that is good. But it's not only the weaker dollar that's helped drive the rand stronger. It's also, we've had commodity prices have a small bounce. And we saw copper rise to a 2-month high on the soft landing story that's being priced into the world. And there's also a chance, we've got the chart on the right there, that the copper price or commodity prices in general could rise a little bit further because of the inventories. So the top chart shows inventory levels, and you can see there how inventories are close to 15-year low. That has led to a fall in the copper price. So we're not expecting China to have a grand recovery. There's not enough stimulus. China's not going to, the property sector is not going to bounce. It's going to flatline. And that means the commodity prices are not going to bounce strong. They're going to flatline. But we could see a little bit of strength come into the commodity market as a result of destocking. So as these inventory levels hit critical low levels, China and other countries will be forced to buy commodities that'll support commodity prices. That is good for the rand. It's also good for our tax revenues, and we could see a slight improvement on the tax revenues in South Africa. So assuming that this destocking helps the rand, and it helps commodity prices, and it helps our tax revenues, well then we could have a bit more positive news come through in South Africa over the next few months, despite everything that's going on in South Africa at the moment. So again, it's all dependent on some quite drastic geopolitical outlooks. Base case is that it's just saber rattling, that Russia doesn't reduce its oil exports, and that there are sufficient oil supply that's come online in the rest of the world, and sufficient food sources, wheat sources that have come online over the last year to keep food inflation and oil inflation in check. If that happens, base case scenario, and destocking of inventories leads to a small increase in commodity prices, well then we should actually see a slightly stronger end to the year, and then we don't need to put on any protection. So that's base case. Upside risk, which is I think is quite low, is that China has huge amount of stimulus. They just do broad-based stimulus, and they just pump money into the economy, and then we're going to see the rand fly, EMs fly, equities fly, and everything will be a winner. So that's, but I give quite a small probability to that. I give a slightly bigger probability to the geopolitical risk rising, but also quite small. The base case is that we continue into this Goldilocks, but with volatility. As inflation, as I said, July inflation is going to be a bit stronger, so we could again see a bit of risk off and a strong dollar in July when the July CPI number comes out, and people get concerned that inflation is not falling. And then once inflation starts to fall again, then the markets could rally. So base case is a lot of volatility with very razor focus on inflation numbers, with some big risks on either side, the upside and the downside. So where does that leave us overall in positioning? Well, as I said, China is exporting global disinflation, and we think that's going to be our base case scenario, which is good for inflation, which will maintain the Goldilocks. So we are positioned for that, but we have put in protection because we do think that there is a risk that we could see higher food or oil price and rises, and even if we don't, that volatility is going to continue to stay high into the summer months of the Northern Hemisphere, or just at least into the end of this year, where it's traditionally we see some weakness. So we've cut our China position to a small weight. We've maintained our neutral Europe. EU is very much driven by global trade. Without a strong resurgence in China, Europe is going to struggle. So we have, we maintain our neutral EU. We've reduced our China overweight. We put some of that into the US. We still underweight the US. We still underweight FANG stocks in the US, despite the having been fantastic business models. We do think that there's a lot of growth priced in, and we could see some downside surprise. We saw some of that come through the numbers this month, where despite all the blue sky around AI, the analysts and the markets were very focused on the traditional business models for the FANG stocks, and we saw some big moves in those stocks as a result of either upside surprises or downside surprises to the traditional client base. And I think we'll probably see a bit more of that come through over the next couple of months. The influence of AI is not to be underestimated, but it's not something that's happening today. And right now we have to worry about the earnings from the traditional sectors. For now, growth remains resilient, but there are big clouds on the horizon in the US in particular, a slowdown there from partly a reduction in household savings. So all that cash was built up during COVID, that's starting to run out. We're also seeing that credit has peaked in the US 8 months ago. So that's credit card spending is rolling over, and we're seeing increase in defaults on credit card risk. Credit cards has also risen. So things are looking rosy right now, but we're expecting them to slow as the lagged impact of interest rates take effect. The market could look through that, but I think there's going to be a lot of volatility around that. Hopefully that volatility, those pullbacks are only 5%, and we move into next year with a good base. But there's some big risks on the downside from a geopolitical side. But there's also some upside risks if China has to inflate broadly. Longer term, we do think our themes are where we want to stay invested. Fourth Industrial Revolution has had a very strong year-to-date numbers. It's actually the strongest sector over the last 7 months, so that's looking very good. So we remain a believer in disruptive technologies, our fourth industrial theme. Healthcare has been the worst performer year to date, but we believe that there's a very strong structural demand for healthcare spending, and that's a theme that we want to stay invested in. Emerging markets have done okay, and we do think that the tech stocks, which make up the biggest exposure in EM, the China tech stocks, will help drive EM, and the rest of the EM will benefit as the US pivots away from China. So we think that that next billion consumers is a structural theme that we have to stay invested in. So, although we changing the shift of that more to EM and more to China tech, we still believe in that theme. And obviously ESG is a big theme that we stay invested in, and that's also done quite nicely year to date. So fourth R and ESG looking quite good year to date. Healthcare struggling, but I think it's a good time to top up on healthcare. EM's doing well, China recovering, but the outlook there not as rosy as it was, and we're focusing our investment. And that is it for today. Thank you very much, everybody, for joining. Let's take some questions. Please, if I can ask, if you are going to put the questions through, don't put questions through as anonymous. It just helps me understand who's asking what, and if there are joint questions, I can then link the questions to the person. That would be a big help. Thank you. Okay, so first question from John: what is the fair value of the rand? And that's always very, very difficult to say. John, what I can say is economists are forecasting, so the expectations, the consensus for the rand a year out is strengthening from its current 18 rand down to 17 rand 50. I think that's fair. I think we could actually see a little bit more strengthening of the rand. It all depends on how much commodity prices bounce as a result of restocking on the inventory side. So that is key because, as I said, commodities are very, very important for South African revenue, which helps our budget deficits. Also very important for our trade account because we export commodities, and also just generally good for overall bullishness of manufacturing. Another very important point, which I haven't mentioned today, is that the world has been very has been bifurcated into manufacturing and service growth. During COVID, people weren't able to spend on services. They couldn't go to restaurants, they couldn't travel. So all the spending was on TVs and treadmills and whatever they could while they were in lockdown. We've now, over the last year, there's been a huge switch where no one wants another TV, but everyone's traveling, everyone's going to restaurants. And so manufacturing has plummeted. Manufacturing is very much leads to commodity demand, services don't. So as that starts normalizing, we are finally, it's taken a while for those lockdowns to come through the base, but we're starting to see a normalization of manufacturing starting to recover. As people start to look at replacing their TV and starting to cut back on their services spend as the world normalizes. That can also help commodities recover. It will also support Europe and the more product-driven economies, and that would also support the rand. So, there are, I suppose, then two things that could support the rand. It's recovery in manufacturing, and sort of recovery in destocking of inventories, and those are linked. So that's our base case. Of course, if we start to see some major rises in food inflation or oil inflation, which will lead to concerns that central banks have to raise rates, or then the rand's going to weaken very quickly. But that's not our base case scenario. So a lot of risks to the rand, but our base case is it strengthens from here. But unfortunately, that's a consensus view at the moment. A good question on how Turkey and China and India are buying oil through the Middle East, buying the sanctioned oil. I'm not quite sure how they're getting away with it. Yeah, it's quite hard to hide oil tankers, but I think one of the stories I've heard is that tankers that are falling apart are bought with full cargoes of oil, and then they bought into a port to refurbish the tanker. So that's just done on a buy and refurbish basis, but the oil is then offloaded, and I think there are ways of getting around those sanctions. The important point is we're seeing the numbers come through, and certainly the numbers are in the Russian export numbers and in the Middle East export numbers. So it is happening. And I suppose you can also see it on the oil price. Oil price wouldn't be as low as it was if that supply wasn't coming into the market somewhere. Andre asks, does the Skeleton Balance 70 fund invest in the Sygnia Life Berkshire Hathaway IPO fund? Andre, it does not. The Skeleton Balance 70 fund does have exposure to US value. And we do that through the S&P 500 value ETF. It's just a more direct way of achieving the same thing. The Sygnia Life Berkshire Hathaway Fund is available on our platform. That hasn't been closed. Yes, there was a notification that the cap was reduced from 45% to 40%, but you still can buy that. So as long as you are below your 40% cap, you can buy that. Or if you are above the cap, you can put 60% into domestic equities or domestic income, and then 40% you create your own capacity to buy those global asset classes, and you can access it that way. Yeah, it was unfortunate that we had to lower that cap, but we got, unfortunately, the regulations there are very stringent. If we cross that 45%, if our Manco crosses that 45% barrier, even for a day, we get shut down. We can't take inflows. And with the rand as volatile as it was, and it got over 20 in May, we came very close to that limit. So we've actually had to build a buffer in to absorb rand volatility without crossing that barrier, 45% limit, and that would negatively impact our clients, because we'd be forced to close those funds to existing investors for cash flows. So it is an unfortunate requirement. We're obviously monitoring that, and if we build up enough buffer, we will increase it again to 45%. But importantly, nothing's closed. you just are limited to that cap and need to create your own capacity to invest. But that, yeah, Sygnia Life Berkshire Hathaway Fund is still a favorite of mine. I think it's a great portfolio and great access for rand-based investors to get access to Berkshire Hathaway. Alex says, based on uncertainty for 2023, would you recommend to move a portion of personal funds to money market? Alex, that is a fantastic question. So, you know, we put protection on in our balance funds. So the skeleton balanced 40, 50, 60, 70 signature. We've put in small amounts of protection. So some of that is done through derivatives. We've got our zero cost fences and zero cost collars, which give you some upside, but also protect you against the downside. And we've also reduced our overall equity weight to slightly below benchmark. So we are putting in some protection. You know, based on our short-term view. So it all depends on your time horizon. If your time horizon is long-term, you know, then if you switch money into cash, you are at risk that the market continues to rise, and it looks through all these risks, and the geopolitics don't take events. So if you've got a short-term view, I would say then yes, move into cash, but have a stop loss. So that if markets rally, you say, okay, well, I need to get back in at a certain level. If you've got a long-term view, then I would continue to hold, because, you know, markets do go up in the long term, but volatility is increasing. You know, maybe one way of playing it is, if you have new money that you want to invest, then you could tranche that in over 6 months, as opposed to putting it all in now, and put some of that into money market as you wait, and tranche that money in over the next 6 months. You don't only have to invest in money market. You can invest in the enhanced income fund. That also has a pretty good capital stability, with over a 10% yield, and that's a great place to wait. So, you know, put money, maybe some money into money markets, some money into enhanced income, earning over 10%, and you can sit there comfortably and then tranche your money in over the next 6 months while we work through this volatile period. Generally, markets, and again, it's no guarantee this will happen in the future, but, you know, the old saying, sell in May, go away, come back in St. Leger's Day, which is late October. So, you know, you could either wait into November or tranche in until November, and then hopefully we get a strong year-end rally like we normally do. Or there's just more certainty to how much the US is going to slow down, more certainty as to what's happening in the US, more certainty as to what China is doing with their outlook. Okay, great question. On what's your views on Elon's mission with X? What is Sygnia's current position on X stock? We do have some Tesla, a very small amount of Tesla in our FANG portfolio. We don't have any exposure to Twitter in our FANG portfolio, so that's you know, not something we have a direct view on. Yeah. Elon likes a lot of controversy. He likes bad publicity as much as he does good publicity. Maybe there's no such thing as bad publicity in his case. But I don't have a view on whether it's good from a brand perspective to change that little bird into an X. Yeah, we'll see what happens. But just on Tesla, as I said, we do have a very small portion. We're worried again that has run very strongly on just hopes, and that there's going to be a turnaround. There's also a bit of a China stimulus story there. China is stimulating their EV market in the hopes that will feed through into Tesla. Tesla is struggling in China just from they can't compete with the Chinese from a cost perspective, and when you look at the overall business model there, things aren't as rosy as we'd like. So hence the underweight in Tesla. Kuba says the Sygnia China New Economy Global Unit Trust is closing. Yes. Because of this, my investment will take a 10% loss. Kubus, I'm aware of that. It is unfortunate. you are invested for the long run. So are we. I would say the best thing you can do is switch that money. So the moment you receive that cash, to avoid being out of the market, you can switch that into the Sygnia ITRIX New China ETF. That fund is going to be kept running, and that fund will not be closed. We did try and ask the FSCA if we could merge those funds so that there would be no impact to investors. We said, listen, can we merge the unit trust into the ETF? They had the same benchmark, then there wouldn't be any capital gains. Well, I suppose you don't have to worry about capital gains tax in this case. I suppose you can bank your capital gain loss. It's unfortunate, but I suppose it's a silver lining. We did try to merge them, but unfortunately we weren't able to merge a unit trust with an ETF. So the best advice I can give, if you want to maintain China exposure, and we are, it's much smaller, but we are maintaining our China exposure, rotate into from the new economy unit trust into the new sector China ETF. They are almost identical from an investment perspective, yeah, that way you can continue to maintain your China exposure. So I'm sorry about that inconvenience. It is yeah, I apologize for that. But right now we just aren't seeing the inflows into that unit trust that we would like. We are seeing inflows into the ETF, and that is, from a flow perspective, sustainable. It's sustainable on its own without any seed capital, so that it will keep running for quite some time. And some good returns from both those funds over the last month. Alex says, what Sygnia funds do you recommend buying with the free cash with respect to uncertainty for 2023? Alex, I hope I answered that with the money market fund and the enhanced income fund. If you are just holding that cash for 6 months to tranche it into more aggressive funds, then those are the only two funds that I would recommend. The bond fund and enhanced income have too much volatility, price volatility, with those two are giving you decent yields with relative capital stability. Jonathan, yeah, again on the Sygnia China New Economy Unit Trust, we're keeping the ETF open. It's just the unit trust that is closing. We didn't see any inflows or very small inflows into the unit trust. There was a big preference for the ETF, and as a result, we decided because we were reducing our view from a big overweight to a small overweight, that we didn't see we weren't able to keep both open. So we've decided to keep the ETF open. Stefan, I hope that answers your question. Tom has given me a wish list, a feeder into our Irish Global Income Fund. So that's also something that I should raise, Tom. We've also put out a notice that some people would have seen. We are closing our UCITS funds. So the Irish Global Income Fund, we are closing. Again, there was no support for those three funds, despite them actually having really good track records over the last 2 years. We will be opening up dollar funds, but they will be in a different wrapper. So we are going to continue to look into supporting that space. We do think it's a very, very important space. We do want to have dollar offerings, but it won't be through the UCITS wrapper. The other reason why we're changing the wrapper is just every day the UCITS compliance requirements become increasingly onerous. The cost to keep those funds from a compliance perspective is becoming more and more and more expensive. And Sygnia is all about low cost funds. It's about getting exposure at the lowest possible cost. And there are much more efficient ways of getting dollar exposure to global markets than the UCITS funds, unfortunately. I mean, I think that they're great products, but the compliance side of that is just making those funds become just unaffordable. We're embarrassed to offer the funds at those fees. We want to offer funds at low fees, and we can't. So partly lack of retail support, but more importantly, I think there are more efficient, cheaper ways that we can offer dollar exposure to our clients, and we will do that. And we are busy researching the best way to do that. So yeah, for now, those funds are being closed. So, but yes, a feeder into a dollar income fund is something we are also looking at. It'll probably be an actively managed ETF. That's certainly something that we're looking at. And we'll keep you posted about that. Yes, a good point, Tom. Emerging market ex-China. That's definitely something that's seeing a lot of flows. We still are quite bullish on China, which is why we think EM as a whole. We've gone from EM plus China to EM plus a little bit of China. The market is all about EM ex-China, and they think that China has no future. I think that China tech still has a very strong future. I think there's some very exciting things happening in the China technology space. We're looking at Tencent or Alibaba or Meituan, all rolling out some very exciting large language models. But yes, it's again something we are discussing an EM ex-China ETF. Lots of different ways of doing that. And it's also something that we are reviewing. Number 3, an energy ETF, including nuclear. Yeah, so that's a good suggestion. We will have a look at it. Thank you, Tom. Some good suggestions there. Dave, I think I've answered that question. Simona says, is the South African economy expected to do better in Q4 going in 2024? Any additional risks besides elections? It's a very good point. Election risks will continue to weigh on South African assets just because of the uncertainty and the fact that there's going to be a lot of rhetoric about NHI and other things which may lead to some concern about a lack of debt consolidation. So I think that you're spot on. I also think that there's going to be a slower rollout to the fixing of load shedding than we'd like. Not from the private sector. I think that's well on track, ahead of track, but just from the renewable, the government renewable range. So we're not expecting a great end to South Africa from an earnings perspective or even a budget perspective, but we're a small open economy, and if we see some support to the global manufacturing, also support to commodity prices, well, then South Africa will actually rally. But right now we are reducing our South African equity exposure on concerns that we've still got some bad news coming through in the short term. A great question on gold and platinum. I've said it before, I don't understand those two. Gold and platinum traded at parity in 2014. Gold is currently trading at double the price of platinum. They're both precious metals. There's actually less platinum than there is gold available on the planet. Platinum is a harder metal and it has more uses than gold. Gold has only been used as a currency in the relatively short term. For most of history, we used silver as a measure of currency, just because gold was too expensive to use it as coins, unless you're buying a castle. So it's I know that emerging markets, central banks are buying gold. How long they're going to buy gold for, at what prices they're going to support gold for, I don't know. I can't predict that, so I'm just avoiding gold. It's an artificial support to the price. If I was going to get involved in a sector, I would choose platinum, but I'm not, because I just don't understand those asset classes. And I'd rather have a company that earns dividends, or a bond that has a yield. Good question from Tyron about the FANG portfolio. The FANG fund does actually have some exposure to China. It's got both Baidu and Alibaba, both technology stocks, and who have announced their LLM, their large language models. And we do think there's an upside there. We're also thinking of putting a little bit of NEO into that just because we are underweight Tesla. So there is some China exposure in FANG. As I said, it's not China that we don't like. The listed tech stock in China, it's just the broad, particularly the Chinese A shares, we don't have any exposure to, because that's very much based on the consumers. So Chinese tech stocks still okay. Wayne, a good question. He says, should interest rates start to drop in line with reduced inflation, would South African bond yields start to decline commensurately? If everything else stays, so ceteris paribus, yes. The yield curve should move down in a parallel fashion, assuming that as interest rates start to cut, which is very good for bonds, and then you'd rather be in bonds. And we are overweight bonds. We do think that that's our base case, that as inflation rolls over, as interest rates fall, that bond yields will parallel move down, and bonds will then give you, over the next year, a 20% return, 11% from yield and 7, 8, 9% from capital. There is a risk, though, that the steepness of the curve could change. If you look at the steepness of the yield curve, it is correlated to some extent to the bond issuance. If the South Africa government has to start to issue more bonds, and they announced it at the budget, because revenue is lower than expected and expenses are higher than expected, then the yield curve could steepen, in which case the back end of the curve or bonds will stay flat, even as the money market yields start to come down. So we'll be watching that very closely. There are other ways that the South African government could fund that shortfall. They could borrow money in dollars, or they could borrow money in very short rates. They may not need to impact or raise issuance in the bond market. So we'll be watching that, but there certainly is a risk that the weakness we're seeing right now in terms of revenue versus expenses will could steepen the bond curve. Yes, a great question on South African retailers that have a very strong run, and South African financials have also had a very strong run in general, despite the load shedding risks. That it has been quite surprising. I think to some extent what we're seeing there is a rotation out of the resource companies into SA Inc. It's because people are concerned that resource prices are going to stay low. I think it's more rotation that's driven that than anything, but definitely risks exist. But then again, there's also been very specific returns. So ShopRite has done well, as has Woolworths, whereas Spar and Pick n Pay haven't. So I think analysts are working out which companies are handling load shedding and which companies aren't, and finding the more defensive ones and investing in that. So it's not that all retailers have run hard. It's a good question. On ESG, I think ESG is always going to be polarized. What's important to one person is not important to another one. Balancing environment with social good is, can lead to incredibly strong tensions. So it is a tough one. Craig, you're spot on. If China is likely to grow at or above 5% this year, why is there such an urgency to stimulate and take on irresponsible debt? That's exactly what the Chinese government is saying. They're saying that we're above our target, 5.5% in H1, and we're going to meet our target this year for growth. We're doing enough targeted support to avoid the Chinese property market going into a deflationary bubble, and so that's why the expectations are that they're not going to do more than they are. I think analysts are saying that China is actually quite close. It should be measuring themselves against Japan, and that a bursting of a property bubble actually has more impacts than you think. And that a lot of wealth is invested in the consumers' homes, and if those home prices don't go up, or they even trickle down slightly, that negative wealth impact causes consumers to continue to save more than they should, which means that the economy continues to bumble along. And that's also fine. There's nothing necessarily wrong with the economy just bumbling along at 5%. I think that if you want to buy commodity prices, or if you want to get exposure to broad China, I think that you're going to for China to aggressively get out of this property bubble, they need to do more. And Japan took 20 years to get out of its property, the ending of bursting of the property bubble. The US took 10 years to get out of bursting of its property bubble in 2008. So China, unless they are more aggressive, it's going to take 10 years to get out of the bursting of the property bubble. Doesn't mean they're not going to grow, they're just going to muddle along. And that's quite important. I think in also partly answering your question, even if they grow at 5%, it doesn't mean that their stock market's not going to do well. I mean, we've seen the big derating, huge derating. I mean, Tencent used to trade at a premium to Apple. It used to trade at double the premium of PE of Apple. It now trades at 1/5 of the PE of Apple. And there's a huge scope for the technology stocks to re-rate just on a little bit more policy certainty that we're getting now with the promises from the Politburo, from Xi Jinping, and hopes that there is more certainty about reforms. Yes, there's no guarantee. It's China. It can change on a whim, and that's why we still like Chinese tech. If the confidence comes back in that things could at least stabilize in the internet sector, well, we can very easily see some huge earnings acceleration in that sector, and then those PEs can start to re-rate, and you can have really good returns from that. And that's why we are keeping an overweight to China. Even if it's small. And if we start to see some traction take place in terms of confidence, maybe we'll get back into China through our ETF. Peter, if you're holding your new China unit trust on the Sygnia platform through a tax-free savings account, you can switch that into an ETF. So that shouldn't be a problem for you. Now, our platform does allow the purchase of ETFs, and ETFs do not have performance fees, so ETFs can be held in tax-free savings accounts. That's my understanding. I hope I'm not wrong. Andre asks a good question about the dollar. Never bet against the dollar. The US is definitely the best economy in the world. They have the most investment in R&D. They have the highest margins. They've got the most creativity, and certainly that reflects in their productivity growth, which makes it a great place to invest. And certainly it's why 60% of the world index is in the US. That said, the US, if you had to take a valuation perspective, just looking at the US valuation relative to its ROE, it should trade at a premium to Europe, it should trade at a premium to Japan, it should trade at a massive premium to major markets, but it's trading at nearly double the premium it should be. So hence why we're underweight to the US slightly. And likewise, the dollar is still, the US has the strongest military. The dollar is still the most used when it comes to global trade. It's not going to go away anytime soon, but it's also very overvalued on a 10-year view. So short term, the dollar still has a lot of legs. Long term, we do think that the dollar is going, the US and the dollar are both going to lose an incremental amount of market share. And just as, first of all, they have to start reining in their debt on the fiscal side, and secondly, the dollar is looking incredibly overvalued, as are their companies. Bernard says, Sygnia strong and passive, but you are launching an active ETF. Yes, we are launching an active ETF. It's going to be identical to the FAM unit trust. It's just going to be an actively managed ETF version. FANG is and always has been an active unit trust. So it will just be the same as the FANG unit trust, just in the ETF space. Sun, thank you. Yes, Taiwan is looking quite exciting. Fortunately, Taiwan also makes up a big portion of our emerging market 50 ETF, so we do get some good exposure through that. Bradley's asking about a double top on the S&P. We could be getting there, certainly. And I think that's going to be part of the volatility that we see over the next 6 months. Even if we break through that, it's going to take some work getting through that. Thank you, Tom. And I appreciate that feedback. Sean asks, what is the outlook of the OSC fund? Sean, that's a great question. I haven't had that in a while. The high interest rate environment in general has led to an issue with funding and raising funding in the private equity space and the venture capital space around the world. So whereas interest rates were at zero, capital was freely available, and you could these companies could raise capital very, very, very easily. Right now, interest rates higher, the companies are more conservative about raising capital. It's not so much that they can't raise capital, it's just that they realize that raising capital at higher levels or high interest rates will dilute earnings because of very, very high interest rate expenses. So there's been a delay to a lot of the capital raisings for venture capital companies and private equity companies. They don't want to raise capital interest rate, they don't want to raise debt at these levels. And they also don't want to raise equity because certain sectors, particularly healthcare, has derated quite a lot as well recently. So, because of the reluctance to raise capital at either expensive debt or expensive equity levels, they haven't, which has led to a slowdown in R&D. It led to a slowdown in the repricing of assets because the only time those assets are priced is when there's a capital raising, because then you have a new benchmark, and then you can use that benchmark to price the existing equity or the existing debt. So things have moved sideways over the last year because of that lack of raising new capital. We probably are going to see, I think, over the next 12 months, a similar sideways move until those companies are forced to raise capital, and a number of them are. And when they do that, I mean, there's still very, very exciting prospects. So the underlying story, the underlying growth hasn't gone away. I think what's happening is it's just not being reflected in the price because there hasn't been a revaluation, because there hasn't been a capital raising. So I think we're probably going to see a sideways movement over the next 12 months. And then hopefully we get a decent kicker into latter half of 2024 or 2025, as we start to see some very strong revaluations in those unlisted entities as they either list or they raise private capital or raise debt at higher levels. So unfortunately, short-term outlook not looking good, but the long-term still a great place to be. We still have exposure to OSC in all our funds, and we do think it's a great exposure to partly disruptive technology, partly healthcare, very, very strong healthcare focus in OSC. And although it hasn't been a contributor to performance over the last 12 months, we think it's still a very important place to be. And we are topping up where we get small opportunities to do so. Johan asked about China debt. Johan, a lot of people are concerned about Chinese debt and defaulting, and that's crippling China. I think debt is not a problem in China. As I mentioned in our previous webinar, Alpine Macro call Chinese debt crisis a hoax, and China's got the highest savings rate in the world. So on a net basis, it's almost got no debt. And as long as the debt is issued in local currency, which most of it is, because it's driven by local municipalities, they can easily avoid or delay or absorb defaults and continue to force growth to happen. Does Sygnia's tax-free savings account allow for 100% offshore investments? Yes, you can buy in your tax-free savings account. If it's discretionary money, you can put 100% of that into an offshore ETF, and it can be completely offshore. So there is no reason your tax-free savings account can't be 100% offshore in an ETF for your discretionary money. So yes, that's a great point. Tom, good question on whether gold is something that we should hold just in terms of geopolitical risk, and it is definitely. Doesn't matter what the crisis could be. Low growth does lead to a lot more economic volatility, political polarization, and we are going to see a lot more protests and riots, which are going to lead to uncertainty. But gold is a natural hedge to that uncertainty. I just think it's also a very expensive hedge. I'd rather look through that or hold cash or something else. Particularly, if you're a rand investor, it's hold dollar cash or hold local cash and earn 10%. At least you're earning a decent carry while you're waiting or holding some cash on the side for those risks. And that is all our questions. Thank you very much, everybody, for joining. I really appreciate your time. I really appreciate your questions. I hope it's been beneficial, and I hope to clarify some of our views and helped you in terms of your investment decisions. All the best for August, and I will see you early September. Thanks very much.